Hi, JoAnne.
Hey Nico, how are you?
Real well. Excited to get started. I will kick it off and then after a few slides, we'll hand it over to you, okay?
Okay, and then I'll take control of the slides. You'll let me
Yes.
share? Okay,
Yes.
sounds good.
Thank you.
Mm-hmm.
All right, well, hello and welcome to our Retirement and Wealth Strategies webinar series. I'll be your host and moderator for the day. I am Nicholas Scarcella, Vice President of RWS. Today, we'll be focusing on our quarterly market update, a deep dive into the state of our economy and what to expect as we enter into the 2024 calendar year. I thought I would start by sharing a few headlines that speak to some of the context we hope to bring you today in today's webinar. These are from my newsfeed today, just looking at my phone earlier in preparation for the webinar. So first, what recession? Growth ended up accelerating in 2023. Next, U.S. economy grew at a shocking pace in the fourth quarter. Next, the U.S. economy boomed in 2023 thanks to consumers opening up wallets. Next, Texas border standoff with Border Patrol continues. Next, Russia accuses Ukraine of shooting down military planes. Next, credit card debt is up and is taking longer to pay down. Next, why California housing market is destined to go up in flames. Two more. Next, S&P 500 hits another all-time high. And finally, Americans' economic outlook brightens as inflation slows and wages outpace prices. So wow, this can be challenging to understand what is truly going on in the world we live in with so many headlines, opinions, and really summarized or abbreviated data to tell a story. So, and many of these can contradict each other, all just within 24 hours. So we look forward to providing our thoughts on the financial markets and the overall economy during this hour. Before I welcome our keynote speaker, Dr. JoAnne Feeney, I'm going to share a brief introduction of RWS and hand the presentation over. So first, back one, RWS, we are a fiercely independent wealth management firm established in 1985 with over 35 years of experience. We do have 17 office locations with our home office in Farmington Hills, Michigan. As a company, we have 32 financial advisors and serve around 7,000, 8,000 families across the country. Here's our core values: education, trust, relationship, compassion, and competency. Starting with education, that's what we're doing here today, providing information to our clients and the communities we serve. Trust, we earn our clients' trust, never abuse it, and always have your best interest first. Relationship, we pride ourselves on the friendship we build and serving multiple generations of the clients we serve. So the children, grandchildren, or the parents and grandparents of our clients. Next, compassion, our patience and understanding to your evolving needs and circumstances. And finally, competency, this is our duty to be experienced, credentialed, and knowledgeable to serve you. Here's our mission statement. The mission at RWS is to be a comprehensive financial services firm with a team atmosphere centered around those important family values. Final slide, and we'll hand it to Dr. Feeney, is your cameras are off, your microphones are muted. This is a Zoom webinar. Please text all your questions. We had to turn off the chat feature for compliance purposes. There is a texting phone number on every slide. The webinar is recorded, so if you want to watch it again or 2-3 times, it'll be on our YouTube channel, or if you want to share it to someone that you care about, we greatly appreciate that. We do want to hear your feedback, so there's a survey that Jenny put together at the end of this webinar. And finally, we're looking at about 45 minutes or so of content with Q&A at the end. Here's that phone number, 833-797-4636, again, on all the other slides. So this presentation we put together, or JoAnne put together primarily, is from one of our trusted partners, Advisors Capital Management, also known as ACM. Dr. JoAnne Feeney is a partner and portfolio manager at ACM, and she'll be presenting our quarterly market update. Dr. Feeney is an absolute treat. We've had the pleasure of working together with ACM for many years now, and you may recognize her from her frequent appearances on CNBC, Bloomberg, and frequent publications in the Wall Street Journal and such. So with her in-depth expertise, financial markets, and her finger on the pulse, we look forward to learning what the future holds here in the U.S. and global economies. And thank you, Dr. JoAnne Feeney, for being part of it. The floor is
Yeah,
yours.
thanks, Nico. Good to be with you guys. Good to see you again. Glad to have an opportunity once more to talk to your group. I tell you what, if you unshare your screen, I will be able to grab control of the slides,
Okay,
and you'll see this slide up again here in a second.
there we go.
All right, I got it. Okay, can you see the big slide? All right, cool.
Yes, you're live.
Okay, so as Nico said, I am on television occasionally. In fact, I will be on tomorrow morning, according to the current schedule. These things can always change, but CNBC at roughly 8:50 a.m. Eastern time, the tail end of Squawk Box, where I'll be talking to probably Joe or Becky or Andrew about what's going on. So you guys get a preview. You get a longer version of what I'll be saying tomorrow morning. So the wonderful list of headlines, Nico, that you rattled off really encapsulates the confusion that's out there in the market. On the one hand, boy, things look great in the U.S. economy. That GDP number that came out today for the fourth quarter annualized growth at 3.3%. I mean, that doesn't sound like a recession, right? And in fact, that sounds like well above sort of the long run, sort of steady state growth rates for the U.S. economy, and it is. That's real GDP, by the way. That's not inflation. That's taking away the prices, just normalizing for inflation. So that's like real stuff that we're producing more of. So let me scroll up. Let's see, back to where we were. Oh, I was already on that slide. Okay, there we go. Now my slides. Okay, so what I want to talk about today is not just the economy, but also the markets, the stock markets. Where are we? How do we get here? What does the U.S. economy and the global economy have to do with the investing environment? And then I also wanted to highlight some talking points for probably the portfolio strategy that a lot of you have clients in, which is our balanced strategy, which is one of the strategies for which I'm the portfolio manager. And it's a pretty big strategy at the firm. I think a lot of you know it. We have different sleeves in that strategy. T3 or tier 3, tier 4, tier 5, or target 3, 4, 5. That refers to the dividend yield in those different types of offerings from our private balance. So anyway, I have some talking points later on in the slides. Yeah.
JoAnne, just so you know, this is client facing. So these are clients we're speaking to right now, not
Perfect.
non-advisors.
Great.
So,
Okay. Thank you. Sorry about that.
No, absolutely. I just want to make sure we speak properly. So thank you.
Yeah, no, thanks. No, so great. So a lot of you folks then, if you look at your portfolios, you may not know the name of it. You probably know, Nico, they are mostly imbalanced, right?
Yeah, correct.
Yeah. And so you're going to recognize some of the stocks that I'll talk about here when I talk about what we are trying to do in that strategy for you guys and how we try to do it. So this will be really fun. Okay. So let me just give you, though, the essence of what's going on in the economy and what happened last year. So you may have noticed that the S&P 500, the market, as a lot of people call it, was up a boatload. It was up 26% last year. But a big chunk of that was due to just a handful of companies, 7 companies. Sometimes it's referred to as the Magnificent Seven or the Super Seven. This is Apple, Amazon, Microsoft, Nvidia, Tesla, etc. So these 7 big companies. And they were responsible for most of the increase in the market. The rest of the market only went up about 10% out of that 26%. So most of it coming from these Magnificent Seven, the rest of it from the whole rest of the market, 493 other companies. And the weighted average increase of those 7 companies was 87%. 87% return in a single year on average for those 7 companies. That's pretty amazing. And they're a big part of the market. So when you talk about the market, you're really talking about 7 companies really dominated last year, just to make you aware. So a lot of the stuff, that you'll see in your own strategies probably didn't come anywhere close to that, although I think Balance did okay. But, you don't want to just own 7 companies because as much as those guys went up, they can come down. Look at what happened at Tesla today, as a matter of fact. Okay, so this is another good way to see what happened last year in the market. So this is from October of 2022, so more than a year ago, when the market bottomed out to the most recent high. And as you can see, that orange line, right, that is how much just the Magnificent Seven, those 7 companies, Alphabet, which is Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, that's how different their behavior was. But they also went down a bunch at the end of 2022, as you can see there. And the other lines are the dark blue, the remaining 493 companies. How much did they go up? About 20 some odd percent from October, the low of 2022, versus the Mag 7, which went up over 60%. So really, it was a tale of just 7 companies for much of last year. Another thing I like to show people is how different was the behavior of the average stock in the S&P 500. So the S&P 500, again, this is again up about 25% last year. The average company, including the Mag 7, the average company was up around 12%, 11.8% last year. But if we look at dividend paying companies, that's the orange line, those stocks were down last year, 1.26%. So what was going on? Was the economy good? Was the economy not good? Why did some companies do so well and other companies not do well at all, like big dividend companies? That SPY-D, that's an ETF that tracks the highest dividend payers in the S&P 500, the top 80 dividend payers. They didn't do so well. Why so different? Well, one of the reasons why so different is because, again, the S&P was driven by those 7 mostly tech companies. Why did they do so well? 2 reasons. Number one, they were all down a lot in 2022, the year before. So some of last year was simply recovery of those companies that had done so badly in 2022. And they did badly in 2022 for a host of reasons. One was interest rates were just beginning to go up. And 2, it was anticipated that earnings would be lower in 2023, and stocks are forward looking. But why did these dividend payers do so badly last year? A couple reasons. Interest rates on bonds, treasuries, corporates went up a bunch. And so a lot of the dividend payers out there in the market, they're like utilities, they're staples, energy, right? They're not really high growth. And so where would you rather get your income? Something really safe like a treasury, or something a bit risky like a stock? They have the same yield. What we saw was a lot of people ran over to treasuries. Now that's not a bad short-term arrangement, but remember, treasuries don't appreciate. So for the long term, for building wealth in your portfolios, you still need to be in stocks. So while last year saw a decline in a lot of the dividend payers, it was a temporary shift out into treasuries. We expect that money to start to come back. And so while dividend payers underperformed last year, they're very likely to outperform this year. And especially so when we look at the second reason why there was such a disparity between different groups of companies in the market last year. So the second reason was that not only did a lot of the tech stocks sell off in 22, so they recovered in 23, but the second reason was, as you're probably aware, there was this thing called generative AI, artificial intelligence, that suddenly became popular and known among the general investing public as well as the professional investing public in the fall of 2022, when ChatGPT became available for companies and people to use. And so with that, it became clear that all of a sudden there was this new tool that could potentially make people a lot more productive. And that tool required a boatload of computing power to be created in the first place. But once it was recognized how powerful a productivity boost this tool could provide, companies around the world said, I got to have it. And so companies needed to make it available, this tool. And again, computationally intensive. So companies like Nvidia that made the chips that make it possible to create this capability saw all of a sudden their demand just go through the roof. Companies like Microsoft, Amazon through its web services, its cloud system, and Google all became in much more demand. Give me some of that artificial intelligence toolkit. And so we saw a big change in people's expectations of what these companies could do in terms of sales and profits not necessarily this year, but for the next 10, 20 years. And NVIDIA, the chip provider, is seeing already massive increases in its sales and its demand and its order book because of the need to build more capability in this area. And so you had this small group of companies do really, really well because of this step change in forecasts for their sales and their profits. Whereas the rest of the world was suffering from high interest rates and substitution into bonds and people being conservative and worried that there was going to be a recession and then there's not a recession. And so there was a lot of other things holding back the rest of the market. This is sort of more of the same. I'm going to skip this. And more of the same again. This is more just, just since the October low of 2023, what happened? When we saw that surge at the back half of last year, notice that, it was a broader rally. So it was really most of the first part of 2023 where the Magnificent Seven took off. Once we got to the end of last year and the Fed was recognized, not more rate increases coming. That is, it was a recognition that, hey, the Fed's going to cut rates sometime soon. Then all of a sudden, everything started to rally. And we'll talk a little bit more about the Fed here shortly. Okay, so artificial intelligence was the big winner, and you saw that last year with all these big moves. I would not put Tesla into that category. Obviously, that's its own animal, and they're not just down 15%. This was printed a few days ago. They're down more like 20-ish, 25% by now. Okay, another thing to look at here is, as I hinted at, so far year to date, again, this is a couple days old, but we've had a pretty broad muted change in the market after a tough start. Dividend payers still not doing terribly well and still really a story of growth. Growth has continued into this year in the enthusiasm among investors. And when we look at sectors over here in the left-hand column, another thing we saw last year is energy fell. Energy had done super well in 2022 when the world was recovering a lot from COVID. But last year, supply of oil really flourished and energy prices came down. And this is despite a war in Russia, Ukraine, and then the outbreak of a war in the Middle East. It's still the case that energy prices are muted, and that's because the US has done such a tremendous job of putting more supply onto the market. And that has hurt, though, a lot of the energy stocks. Staples, again, I mentioned, there are a lot of dividend payers there, just didn't do well last year. And similarly, utilities, place people go to find some yield, didn't do particularly well last year. So growth still remains the story, and we expect that to continue to some degree, but we also think there's hope for a broader rally that we're starting to see here at the beginning of 2024. One thing that's worth noting is people ask, hey, is the market cheap? Is it expensive? Should I be in stocks? Okay, by now you know from your folks at RWS that being in stocks is important to build long-term wealth. Some people, though, ask, hey, what about the prices of stocks? And right now, the overall cost of getting into a stock, the price relative to earnings is one way we measure that. That forward price to earnings ratio is about 19.5 times. That's at the higher end of what's normal, but it's still within the normal bounds of these green dashed lines. So it's a little bit expensive, but it's not ridiculously expensive. It's not something to be worried about, especially because at ACM, what we're trying to do is find the value-oriented stocks, right? We don't want to own the super expensive stocks, particularly in a strategy like Balanced, where we're trying to be more conservative, mix together quality growth with quality dividend payers in order to deliver what would be less volatility in a portfolio and still some yield and still some appreciation.
JoAnne, can you share a few value stocks just as an example, 2 or 3 names that you
let me just
consider value?
Yeah, let me just pull up my my magic list here so I can give you the exact what I mean by value. So like in Balance, for example, if I look at let's see, a Plains All-American, right? It's a pipeline company. Okay, it's in all the different sleeves of the private balance. So if you're in Balance, you own this. This trades at 12 times earnings. That is 12 times the next 4 quarters worth of earnings. So if there's $1 of earnings, you're paying $12 for that stock. Okay, that's what we mean by a PE of 12. 12 times that, whatever number the earnings comes to for the next 4 quarters, for the next year. Another example.
And at 12 times PE, JoAnne, for example, is below that lower dotted line, green line on this chart.
Yeah, it's definitely lower than the market. It's lower than even the market would be if the market was trading cheap. But
Mm-hmm.
it does. That's not just, as I mentioned, energy sort of trade off. Chevron is trading at 11 times. But you can even find value in technology companies. One of the ones that's in the balanced strategies is Cisco Systems, for example. That's trading at about 13 times. And another one, let's see, Qualcomm trading at about 14 times. So you can get growth and not have to pay too much for it. And we think Cisco, for example, is right in the middle of the expansion of AI, because you need
Yeah.
more data centers. You need more servers in those data centers. You need more connectivity between those data centers. Cisco does all of that. And so we think that's another really good opportunity, really good value.
That's great. Thank you.
Yeah, you bet. Good question. Thanks. And so, I'm not going to go through all these slides. I just wanted to point out, though, that you have to be careful when looking at the S&P 500. That is not the market you guys are mostly playing in, because you don't want to just own, you know, the 500 biggest publicly traded companies in the United States. You want to be more selective than that. You want to own the particular set of companies that's going to do what you want it to do over the long term, which is deliver you some income, right? Some yield through dividend payments, along with what we're doing for you on the fixed income side. You want to do it with a bit less volatility than the market's going to do, and you want to be diversified. Because while last year was great for those magnificent 7 companies, who knows what this year is going to bring? We like some of them, we don't like all of them, and we do not want 33% of your portfolio to be in just 10 companies, or 25% to be in just 7 companies. And those top 10 companies are trading at 29.5 times earnings. We said the market was at 19.5. The top 10 are really expensive. They're 29.5 times earnings. The rest of the market is cheaper, 17.9, 18. So there are plenty of values out there. As Nico just got me to give you examples, right? There are plenty of values out there. You just have to look for them. Okay, now value is still cheap relative to growth, and that's why we still like going there to find good dividend payers and quality growth companies, as I just mentioned. Last year, there wasn't a lot of EPS growth in the market as a whole. It was a weak year, even though we didn't end up in a recession, even though GDP grew pretty well. It wasn't a great year for earnings for the big public companies, partly because they did so well the previous year. And earnings are always quoted on a year-over-year basis. So yeah, they didn't get earnings growth last year, but they had a heck of a lot of it in 22. And guess what? In 2024, there's a lot of earnings growth coming, it looks like. And this is what, changes from year to year. Okay, but one thing you're doing in balance, right, is you have exposure to bonds, right? I don't know. Our default is 70% equities, 30% fixed, but you get to pick. And one thing you're getting out of those bonds today is income, is coupons, right? We're delivering 4 or 5% yield on the fixed income side, depending on what strategy you're in. And this graph here shows you what a bond fund would do. And it didn't do much last year. It sort of started and ended at roughly the same place. We did better than that for you and delivered you some income. And so that's the buffering part of fixed income for a balanced strategy. And it does what it's supposed to do. It's supposed to provide a bit of a buffer, lower volatility, and deliver you some income. So we're doing that, and we're seeing some good stability there. So I wanted to talk a little bit about the US economy. Look at just the top line. 2016 out to 2025, real GDP growth. Okay, generally it's like 1.8, 2, 3. Okay, last year this number is going to be revised up. It's going to have come in around 2.5. 2.5% real GDP growth. Then throw inflation on top of that, nominal GDP grew about 7%. Really good for the US economy. We shouldn't expect such good numbers to continue. Okay, we don't expect a recession. Doesn't look like anything in the economy right now is broken. Market forecasts, though, do point to the Federal Reserve cutting interest rates. And let me move on to find a good chart to talk about that. Here we go. So the Federal Reserve has two goals. One is to maintain price stability, and the second goal is to maximize employment. So it's called a dual mandate. Neither goal is more important than the other. They're supposed to do both. And sometimes these goals are at odds with each other. Right now, obviously, we've been in a situation where the Fed has been trying to get inflation under control, right? It was much higher. And so the way they do that is they raise this short-term interest rate over which they have control. It's called the federal funds rate. And so, 2021, it was like zero, basically. And then inflation was a lot higher than the Fed expected for longer than they expected. We knew there was going to be inflation because of the shortages of the pandemic. Not enough goods, a lot of demand, prices went up, inflation was high, and it was more persistent than anybody expected. And so they started to raise interest rates to try to reduce demand. Higher interest rates raise the cost of borrowing, makes the cost of buying a car higher, makes the cost of buying a house higher, makes the cost of buying dishwashers and washing machines and anything else that's you're using a credit line to buy. And then every company that's trying to borrow money to build a new factory or to do whatever, all of a sudden the cost of financing goes up, right? So that's why higher interest rates are helping to bring down inflation. It's supposed to reduce demand. And when there are shortages, that reduction in demand is supposed to bring inflation down. And that's basically what's happened. The Fed raised rates a bunch. We're well over 5% now. And so there's been this debate. Okay, is the Fed done? Well, the inflation target is 2%. We're not there yet. We're getting there. Definitely came down a lot over the last year, but we're not there yet. And when we see data like we've seen over the last week, very strong GDP growth, strong labor market, rising wages, strong consumer spending, retail sales, there's some concern that the Fed will need to keep interest rates higher for longer to make sure demand doesn't get ahead again of where supply is. And so there's a forecast that rates will fall. We are more conservative than this official market forecast that I'm showing you. We think that the Fed is probably not going to cut rates in the first half of the year. Maybe they'll be able to cut rates in the second half of the year, depending on what the data shows. And so
JoAnne,
inflation has come down, and we expect it to continue to come down.
JoAnne, this be timely question. So we throughout the past week been asking advisors and clients what's on their mind, preparing for questions for you. So this is Kathy from Columbus, Ohio. What should I do with the cash I'm sitting on, roughly $150,000 surplus outside of our investments? And this is a great question, JoAnne, because if we look at money market yield right now, you can go in a money market fund with Vanguard and get 5.28, it's a 7-day yield. We're talking about the longer curve. So what would your response be? Duration is a big part of this right now, and how much you want to go out, how long you want to have for duration for your fixed income, correct? What do you see?
Yeah, it really depends on when do you need the cash. Is this the kind of cash that's supposed to sit there in an emergency? I need to be able to get that cash. And if
Surplus.
that's the case, what's that?
More surplus, not so much cash reserves emergency fund.
So cash that you are sure you're not going to need to touch for 6 months or 2 years, or I
Yes.
think that when you don't, you want to use this cash to might as well make money off of it,
Yep.
right? And so if it's a pot that you want liquid, but you don't need it, it's not an emergency, I would buy a treasury, buy a 6 month treasury, a 1 year, a 2 year, whatever is um, the longest duration you can stomach. I wouldn't be making a bet right now about interest rates. I mean, yeah, they could go down. You could end up staying where they are for a year. So you don't want to make a bet with your money on which way interest rates are going to go and when.
Yeah.
But I think it's worth, getting some income off of that cash. Now, if you know for sure you're not going to need it for a while, then I would roll it into the fixed income side of the balance strategy, because the danger of just putting it in a money market or buying a treasury bill with it is that you have reinvestment risk.
Yep.
When it matures, you have to reinvest it. And by then, interest rates could be half of what they are now. Whereas the fixed income team at ACM is putting together bond from corporations And that collection of corporate bonds is something that's going to enable the interest payments to last for longer at this higher level, right? So that you can get rid of the reinvestment risk. Our duration on the bond side is probably around a little bit under 4 years. So you're going to hold on to that rate of return on the fixed income side. If you go into corporate bonds, you won't be able to do that in a money market or in a treasury.
The short-term money is good, but reinvestment risk is the biggest concern
Yeah,
there.
you're just not
Like the
going to
money
benefit
market.
from yeah, you're not going to benefit from for very long. And according to that forecast on the previous slide, you're going to lose that in a hurry. You're going to lose that in a year. It's going to just the interest rate's going to drop. So
Yeah.
if you put it on the fixed income side where we're investing it for you, you're going to be able to lock in that, 4-ish, 5-ish% return for years as opposed to 6 to 12 months.
Very good. Thank you.
You bet. Okay. Now, when we look for stocks, we recognize that structurally, long term, stock prices follow earnings. And that's what this longer term picture is, like 5-year chart. The blue line are forecasts of earnings for the S&P 500. And the white line is the stock market. Notice that they kind of follow each other around, right? Stocks tend to move ahead of earnings because there's a lot of forecasting going on. And so when you're investing, it's really easy to lose sight of the fundamentals with all the noise that's around you, whether it's macroeconomic, political, geopolitical. But fundamentally, this is the chart to have in your head, and even better, a longer term view. Earnings drive stock values. Why? Because a company is only as valuable as its future sales and profits. When you own a stock, you own a piece of a company. You want to own companies, they're going to be able to sell more stuff and generate more profits year after year after year. The more stuff they can sell, the more profits they can generate, the more valuable that company is, and so stock price goes up. That's all it comes down to. So that's our job, is to try to figure out which companies are going to be able to do that. Now, is there a recession coming? Yes, I will tell you for sure that there is a recession coming. Just don't ask me when. I'm an economist. I can tell you for sure recessions happen. We don't always know why they happen, and we really can't predict when they're going to happen. So all of the news chatter, oh, when a recession is coming now, a lot of that came up because, hey, the Fed raised rates so much. And people just thought, well, that raises the cost of doing business. It raises the cost of borrowing. Surely that's going to cause a recession. Well, it didn't. And now we're on the cusp of the Fed cutting rates. So it looks like that reason for a recession has gone away. Now, there may be some other reason. Who knows? Right? Things break in economies, and they often break unpredictably. We don't see anything right now on the horizon. And in fact, all the indicators of recessions, all the things that are tracked to see whether we're going to end up in a recession or whether we are in a recession, all of those things really mostly are kind of greenish. And so we're not so worried. In fact, they've all kind of improved. These blue bars indicate things have improved over the last 6 months. So things look pretty good. Okay, unemployment is low. We're down here below 4% unemployment, that gray line. Wage growth is high. Real wages are growing. That is more purchasing power in the pockets of households. That's good. More money to spend. That's why consumption's been so good. Labor force participation, percentage of people working, percentage of people looking for work is high. It's down a little bit from pre-pandemic, but it's still pretty good. Yes, household debt has risen. That's this right-hand side. But it's about in line with where we were pre-pandemic. It's not alarming. So if you see headlines about household debt and credit card debt being up, it's not alarming. We're sort of at pre-pandemic, and those levels were not alarming. Yes, some people are starting to default on their auto loans. Yes, they're starting to default on credit card loans. It's a little bit higher than where we were pre-pandemic. Okay, grant you that. Student loan delinquencies, obviously, those are way down. So that's something to watch, and that's what we are watching, because there's always risk, and we want to sort of keep our eye on it. Credit card debt, again, it's lower than where we were before the pandemic. Okay, but the labor market is weakening. There are fewer job openings than there were a year or so ago. fewer people are quitting their jobs. That's what this JOLTS quit number is. Fewer people are quitting their job, which indicates that, okay, maybe people are starting to get worried about whether there's no job out there for them. But layoffs haven't really increased that much. Still pretty low. So again, things look pretty good. Um, the reason why consumer has been so strong, by the way, is sort of in this picture. More people are getting paid. More people are getting jobs, and therefore household payrolls are up. They're just taking home more money. They're able to go shopping, and they're able to buy more stuff. The real personal income, your disposable income for your households, has been growing for the last year and a half. That is, more stuff can go into your shopping cart than before because you have there's more real disposable income in the pockets of households. And that's why consumer's been so strong, and that's why we're seeing spending continue to rise. And firms too are investing, and they are investing in future capacity, more factories, more output coming out of those factories. And so that's a point of insight into the future. If firms are investing in factory capacity, that means they're going to be able to produce more stuff in the future, and that's a positive thing. Okay, so last year we've just wrapped up, as I said, the market, as encapsulated in the S&P 500, saw basically no earnings growth relative to the prior year. And in fact, healthcare was an industry that saw earnings drop dramatically. Materials saw, and energy, with a drop in the price of oil, they saw profits drop 30%. Consumer discretionary, though, did very well. That's Amazon, Tesla. Communication services did very well. But this year, it's a really different story. There's expected to be growth across almost every sector, with the exception perhaps of energy. But healthcare, which did so badly last year, likely to do very well this year. Information technology is sort of middling last year, likely to do very well this year. Why? Because people last year took a break from buying PCs and smartphones. Why? Because they bought a bunch from them during the pandemic and they didn't need a new one. Well, guess what? Now those cell phones are 4 years old. I know it's hard to imagine that we're 4 years after the pandemic started, but here we are. And those cell phones are 4 years old and people need new ones. People need new PCs. People need new printers. And so that's one area of information technology that's expected to grow. Okay, so I just want to say a couple words about balanced. Just wanted to give you a reminder of what we're trying to do for you on the equity side of T3 balance, which is our 3% target dividend yield version. We have a T4 balance, which targets a 4% yield roughly. We have T5 balance, which targets roughly a 5%. Those are all gross of fees, and those are all dependent upon market conditions, but we're sort of in that neighborhood given what the market's doing right now. So in T3 balance, we're trying to do between 2.5%, 3.5% equity yield. But remember, yield is not the only goal, right? We're also trying to be broadly diversified. We want to own stocks in almost every end sector, right? From energy to utilities to consumer, right? Tech, et cetera. And we do that because it helps us to defer risks longer term. Some years like last year, healthcare did terribly, but tech did pretty well. And consumer discretionary did pretty well. So if you own companies in different sectors, you can sort of get rid of some of the sector specific risks that are out there. And hopefully that keeps the portfolio from being too volatile. Also, right, we're trying to have a lower volatility versus the market. And we're trying, though, also, in addition to delivering yield, which is well above the market, by the way, the S&P's yield is like 1.8%. We're trying to do 3, so nearly double. But we're also trying to get you appreciation. And we're doing that by owning some high quality growth stocks like Broadcom, like Cisco, like IBM, by the way, which reported last night and was up like 12% today. That doesn't happen very often. Don't expect it, but it's nice when it does. So our approach to delivering these goals, yield plus appreciation and lower volatility, is a barbell approach. We mix in some generous dividend paying companies in order that we may also put in some zero dividend paying growth companies or close to zero dividend payers, like an Amazon, like a Google, a Microsoft, which doesn't pay much of a dividend, or an Apple, which doesn't pay much of a dividend, right? We want those growth-oriented companies. And it's not just they're growth-oriented, it's that they are core to the future of the global economy. Another one we have in T3 is Palo Alto Networks, cybersecurity. If you're reading the news, you're hearing about these hacks. Microsoft emails were hacked. This hospital was hacked. This oil refinery was hacked, right? Hacks are everywhere. Well, cybersecurity companies like Palo Alto are the first, second, and third lines of defense. They've almost become a utility. They're that important. And so we wanted to include Palo Alto in the holdings for the T3 balance. Now, if you're in T4 or T5, everything in there has to pay a dividend. It's the only way we can get you a 4% average yield or a 5% average yield, is we do have to drop the zero dividend payers. But that's the trade-off you make. You get more income, you give up some appreciation. Okay, so our goal is a barbell approach in T3, some low or zero dividend payers along with a bunch of more generous dividend payers. And I just wanted to make it clear that when you're looking at your portfolio and thinking about, hey, what's my portfolio doing? Don't just think about it relative to the market, this S&P 500 or the Dow or the NASDAQ. That's not the world you're playing in, right? You're playing in the world of, yes, the S&P, but also dividend payers. So whether it's a large cap dividend index like DLN, which is the ETF, or the high dividend index that I mentioned before, SPY-D, these two, if you look at those, you'll get some insight as to what dividend paying companies are doing. And your portfolio is going to kind of be between those two, between the S&P and these dividend payers. And the thing to remember is that markets are volatile. This chart here shows you in the red dots, I'll just pick a spot right here, minus 34%. That's how much the market went down in 1987. The market ended that year up 2%. In the early 2000s, the market was down 30, 34%. Had a couple of bad years. The market ended up down. But look what happened after those bad years in the early 2000s. There was a run of 5 years where the market was up 26% in that first recovery year, and then still very solid growth. And also, when you look at this chart, notice that most of the years, the market ends up. That's what these gray bars are, where the market ended. So most of the time, the market goes up. Why? Because the market is full of companies. Companies are making more stuff. They're selling more stuff to a growing population and growing wealth in the population, producing more stuff, getting more profits, and therefore becoming more valuable over time. That is the market. And so long as the world continues to grow, stock valuation should rise. And so we shouldn't be alarmed when the market does go down intra-year, as it tends to do. More than half of the time, there's a market's down more than 10%. And yet, in more than half of those times, the market ends up. So just a little perspective to keep in mind. Obviously, investing in equities is a long-term gain, but fortunately, you have history behind you to stay the course. Okay, let me wrap it up there, Nico, and you can see if there are any more questions.
Yeah, thanks, JoAnne. You are bringing the incredible perspective, so we thank you for your time and your knowledge. We do have a few questions, looks like about 3 more. One was on the housing market, so you touched on it, but what is your outlook? You believe inventory challenges for the full year? Will interest rates, if they are reduced second half of the year, that will just cause that much more demand? What does it look like for 2024 for the housing market?
Yeah, interest rates is an important variable, obviously. But what's happening so far is I think everybody's probably aware. If you own a home, you don't want to sell it and
Yeah.
lose your low interest rate mortgage. And that's why there are so few existing homes on the market. So the existing home market and the new home market are completely different markets at this point. Existing homes prices are up. There's not much supply. New homes, well, the builders are building them as fast as they can, but the high mortgage rates did cause a reset, and they had to work with their buyers, a lot of them whom are young, take some of the bells and whistles out of the houses. So they've actually seen a price decline in single family homes relative to the peak of late 2022 when those rates started going up. And so for this year, right, because we are expecting rates to go no higher, in fact, long-term rates probably come down a little bit, we continue to see strength in the new home market. And so we continue to like Lennar, which is over in our growth strategy. again, mortgage insurance company over in our growth strategy. In
Mhm.
balance, those are a little bit more, they're more risky, right? They're going to be more volatile. And so we don't own them in balance, but we do own derivative plays like a Williams Sonoma, for example, because you buy a house, you're going to have to put pots and pans in it, right?
Yeah.
And furnishings and other things. So there's indirect ways of playing housing. But we do expect the housing market to remain strong. There's just a shortage. The inventories are low. Demographics are such that a lot of people in the prime ownership ages do not yet own a house.
Thank you. And this is something that we hear is coming up in a lot of our client reviews, it being an election year. Historically, how have elections impacted the financial markets, and what does that mean for the retail investor, if anything, for
So
this calendar year?
historically, the data shows that the party of the administration has there's no relationship between that and economic growth. So the party of the president is irrelevant historically.
Okay.
Now there are always data you can look at it. Oh, but under this president, growth was this, and under this president, growth was that, and weren't the Trump tax cuts useful? And sure, there's always sort of one-offs you can look at. So when you look at this particular election, it's unlikely that we're going to see another cut in the corporate tax rate. And it was the cut in the corporate tax rate that was very useful for companies' profitability in the
Mhm.
2017, 2018 time period. We're not going to get that again. So from a corporate tax rate perspective, there's really nothing at stake in this election. There's some question about whether certain personal income tax rates cuts will be extended. And I just saw a headline today that said Janet Yellen said that another Biden administration would likely continue to extend those tax cuts too.
Oh,
So it doesn't seem like that's an issue. If that's accurate, I don't know. This was a headline I saw in Bloomberg, but
watch out for those headlines, JoAnne.
yeah, exactly. No, right. So again, generally the party of the president doesn't matter for economic growth. One, you know, depending which side of the news shows you're watching, you
Yeah,
could have a very different opinion from that. I'm not going there in this
yeah,
discussion.
not today.
Just be aware that the U.S. economy is resilient, and businesses are going to figure out how to sell their stuff regardless of
Exactly.
who's in Washington. And the companies we own, we think will continue to be able to sell their stuff, run well, keep costs down, take care of their customers, take care of their workers, do a good job. We own quality companies with quality management teams, and we think they'll be fine regardless of who is in the White House. So we don't see it as a big risk factor for the companies we own.
Okay. So for going from USA to international and global, I'm going to blend these two questions into one. So first was, how do you feel about the European market? So for the past several years, there's been talk about the exposure and hasn't really fully taken off. Second question is, if you were going to invest in one country outside of the United States, where would that be and why? What country do you like the most at this point?
Yeah, okay. So the whole globe went through the pandemic,
Mhm.
right? Every country had issues. Every advanced country had the wherewithal to support their citizens during the worst of the pandemic. So big fiscal spending programs. And most developed countries had significant inflation problems because of the mismatch between demand and supply. We're all recovering at different rates. China seems to be recovering most slowly. And despite official data, which they put out and people kind of roll their eyes and say, yeah, did you really grow 5%? And we don't think so.
Yeah.
So there's a lot of doubt about that. We have international portfolios here at ACM. We think that international exposure is a very important strategy for risk diversification. In fact, as an academic, when I was doing my work in graduate school, one of the big puzzles was why the heck are people so poorly diversified internationally? What is the home bias, as we called it back
Hmm.
then, of people? And it's persists to this day. Now, there's a way to get international diversification by owning multinationals. And in fact, in balance, we have a handful of international companies. So we're getting some of that in balance. But we have multiple strategies at ACM. We have international, we have global dividend, we have global growth, and we have international ADR, which is purely international. And so we don't think it's wise to pick a country. In fact, we don't invest that way at all. We pick companies,
Companies.
and we find companies within countries because it's you have to take into account politics, leadership, the rule of law in different countries. And then you got to find out how the companies fit in. So I would not advocate picking a single other country and going and investing there. I think that's overly risky. I would instead look at our international ADR portfolio. And I think diversification internationally is a terrifically good idea. I don't think people do it enough. And right now, the valuations on some of the international stocks are much lower than they are in the United States for some companies that have very, very similar growth prospects to what we can get here in the US. So there are some good opportunities out there.
There's a lot of good companies that are household name brands here that are international companies as well.
Yeah, I mean, Unilever is an example,
Yeah.
right? We own Taiwan Semiconductor. There are also a lot of companies that are headquartered in foreign countries that you would think of as American companies, like Medtronic, which I think is Ireland. So yeah, there's a lot of ways, but a lot of the multinationals, you're getting global exposure anyway. So
Well, that's gonna be where we end it. You have an early morning and 8:50 a.m. Squawk Box. Is that where it's gonna continue tomorrow
yes,
morning?
yep, tail end of Squawk Box.
So we appreciate our partnership with ACM and all of your insight and knowledge. Thank you, JoAnne.
I'm glad to be here with you guys, and everybody have a good evening.
Thank you. Take care.
All right.
We'll see you in the next one.
Sounds good. Take care.
Bye.